Hi, my name is Roger Slater. This video is actually about common financial statement ratios for business and their uses and significance. Ratios are very important. Bankers rely on ratios a lot. So anyway, we're going to look at liquidity ratios. We're going to look at actually 5 different types: liquidity ratios, profitability ratios, efficiency ratios, solvency issues, and market value ratios. So anyway, all 5 of those are important. Market value is more for stocks and bonds for public companies, so we're really not going to look at any absolute numbers for that, but we'll show you how to get those ratios. And then number 2 is I'm going to show some financial statements, P&L statement, and a balance sheet. The P&L statement is from LendingTree and comes from their website. So anyway, or a website I found, and it said it was from LendingTree. Anyway, that was an income statement. It's just an example of an income statement. And then the balance sheet comes from a CPA, John Gilliam, and he has this lessons on accounting, and he does have accountingplay.com that you could go to. But anyway, he just showed this as an example balance sheet. So I'm showing it, but I am giving him credit for it. So anyway, and these, they don't have the same names on them. So anyway, we're just gonna pretend that they're the same. So I'm gonna put those up, throughout this video, depending on what we're looking at. So anyway, number 1, liquidity ratios. What are they used for? They are used to determine a debtor's ability to pay off current debt without raising external capital. Liquidity ratios also show the margin of safety that the business has. Liquidity is the ability to convert assets into cash and to do it quickly and inexpensively. Liquidity ratios are most useful in a comparative form, and that means showing like year to year or quarter to quarter, but usually year to year, and really comparing them for that company. They can compare month to month, year to year, or even company to company if they're related in the same industry and they are relatively the same size. You can sometimes do that also. They are mostly used to track changes in the business. So anyway, number 1 in this category, in basically the category of liquidity ratios, is the current ratio. And the current ratio measures the company's ability to cover short-term liabilities with short-term assets. If they can do that, then the lender or financial institution really has no problem with the short-term liability of the company or ability of the company. It does indicate the company's liquidity and ability to meet medium and short-term obligations. So anyway, the actual equation is current ratio equals current assets divided by current liabilities. Now we would kind of want this ratio to be usually around 2. If it's below 2, that's not bad. It should be at least 1 or 1 something. But normally we'd want it to be around 2 or higher. So anyway, if we look at this balance sheet, we are talking $149,000 for current assets, and then current liabilities is $47,000. So when you do the math, it comes out to 3.17, which is really good. That's a good current ratio. Number 2 would be in the liquidity ratios would be the quick ratio, and sometimes called the acid test ratio. This ratio is the current ratio minus the inventory. Anyway, we're looking at a more stringent measure of liquidity in a short-term basis, and that's why they sometimes call it the acid test ratio. So anyway, the quick ratio is the current assets minus inventory divided by current liabilities. So anyway, it's a very important. The current ratio and the quick ratio are probably the most important liquidity ratios that the bank looks at. Well, they are, absolutely. And a lot of times they're one of the better or the most important ratios of all the ratios that the bank looks at. Number 3 would be the cash ratio. I really don't use this too much. It measures the company's immediate ability to cover current liabilities with cash resources. So the cash ratio would be the cash divided by current liabilities. So anyway, hopefully we would want this to be, we just wanted to cover at least 1-to-1, I would think. It could be lower than that. So anyway, if we look at the example that we gave, 149,000 minus the 15,000 minus the inventory divided by 47,000 comes to a 2.85. And that's pretty good. That's a good one, because you do have enough cash to cover current liabilities. You're not going to go out of business tomorrow. You're at least going to make it for the foreseeable future. If it's a yearly statement, you'll probably make it through that year. So anyway, you can a lot of the lenders or whoever can really understand that you'll make it short term. So anyway, the profitability ratios. Profitability ratios are used to show a business's ability to earn profits from its sales or operations, balance sheet assets, or shareholders' equity. They show how efficient a company generates profit and value for shareholders. They are used comparatively to show changes in the profit month to month, year to year, company to company. But when you're doing company to company, you need to do the same size company in the same industry for it to really mean anything. Okay, so as we go, the profitability ratios, the first one would be gross profit margin. And it would be the percent of revenue retained after subtracting the cost of goods sold. So you'd have your gross profit margin equals gross profit divided by revenue. Now what that's going to give you, it's going to give you a percentage. So you can multiply it by 100 and say this percent. If you want to. Usually most of us just look at that 0.45 and we just say it's 45%. So anyway, in this example in our balance sheet, the gross profit is 90,000, and then we divide that by our revenue, which is 200,000, and we come out with 0.45 or 45%. The second profitability ratio is really net profit margin. And net profit margin, the percent of revenue that remains as net income after subtracting all the expenses. It reflects the overall profitability of the company. And the net profit margin is arrived at by net income divided by revenue. So anyway, your net income of 44,500 divided by 200,000 is going to be 0.22 or 22%. And for a net profit margin, that's not bad. I mean, 22% is pretty good, is really good. So anyway, that'd be something that the company would be very proud of. Profitability ratio number 3 is return on assets, right? Sometimes abbreviated as ROA, return on assets. Shows a company's profitability in relation to its total assets. A higher ROA indicates the company is more efficient and productive in managing its balance sheet to generate profits. The ROA, return on assets, equals the net income divided by total assets. And in our example, we have the net income be 44,500, and then divided by total assets would be the 472,100, and that equals 0.094 or 9.4%. Now, for return on assets, anything approaching 10% or higher is really good. When you can get a 9% return on your assets, I think that's really good. Of course, it does depend on the companies. If you had companies that are in the computer section or in that arena, sometimes you'd have a really high ROA and ROE, which I'm going to cover right now. Return on equity is the ROE, and really shows how effectively the company makes profit for shareholders' equity. The higher the ROE, the return on equity, the more efficient the company's management is at generating income and growth from equity financing. So anyway, your return on equity would be the net income divided by shareholders' equity. So anyway, in our example, we come with net income 44,500, shareholders' equity, when you actually do the math on it, 225,100, and that equals 19%. And 19% as a return on equity is actually really good. Depends on the times, but it is really good. So anyway, efficiency ratios we're going to look at now. And efficiency ratios are used to show a company's ability to use its assets and manage its liabilities effectively in the current period or in the short term. They are used to compare month to month, year to year, and company to company. So anyway, efficiency ratios, there's actually should be 3, and the first one is inventory turnover. And this indicates how quickly a company sells and replaces its inventory. The higher the turnover, the better is usually the norm. You know, the higher the better. The higher the better turnover. And the actual equation is inventory turnover equals cost of goods sold divided by average inventory. Now, we're not gonna, we don't know what usually what you take is you take if you're doing a yearly statement, you do the beginning year inventory, and then you add the ending year inventory, and then you divide by 2, and that's how you get your average inventory. So anyway, here we're just going to use the inventory as it is. So basically, you multiply by 1, or whatever, divided by 1, whatever. So anyway, but we're just going to use just the regular inventory that's really on the balance sheet. So anyway, that would mean the cost of goods sold of 110,000 divided by the inventory 15,000, and that would end up with 7.33. Now, I think this actual financial statement is a quarterly statement, so a 7.33 inventory turnover probably is not that bad, because it means that this company turns their inventory completely over 7.33 times in a quarter, which depends on the inventory, the amount, but and the different sizes of the, what the individual costs of the product are, but still that's ordinarily very good. The other efficiency ratio is the accounts receivable turnover, and this shows the efficiency of collecting receivables from customers, because the accounts receivable is what customers owe you. They show how quickly the company collects cash from credit sales. So anyway, the account receivable turnover equals the revenue divided by average accounts receivable. And like I said again, average accounts receivable is, if it's a yearly statement, it's what you have in the beginning of the year, plus what you have at the end of the year, divided by 2, give you average accounts receivable. Or if it's quarter, the same thing. The accounts receivable in the first part of the quarter plus the end of the quarter divided by 2. So anyway, it's a very easy thing to come to get. And actually on tax returns, which most of the banks and financial people use tax returns, they really don't want to use financial statements, because they feel like whatever you report to the government, the sales are going to be correct and the expenses correct, or even probably lower than you would have if you just did the numbers yourself. So anyway, that is very good. Now the third one is the accounts payable turnover, the third efficiency ratio. And the accounts payable turnover shows how effectively a company manages its accounts payable by showing, this is very similar to the accounts receivable one, and shows the number of times that it pays its suppliers within the period. So anyway, accounts payable turnover would be the purchases divided by average accounts receivable. Now, you have to know what those purchases are. Sometimes they might be cost of goods sold, but they could be other things too. So really, you need to know what the total purchases are. And so in this instance, we really don't know what the total purchases are. So we're gonna leave that one. Anyway, number 4. There actually is a fourth one, which I thought I had 3 for every category. But anyway, the actual fourth efficiency ratio is asset turnover, and shows the efficiency of the company's asset utilization in generating revenue. Measures how effectively the company uses as assets to generate sales. Asset turnover would be your revenue divided by total average assets. And like I said, the average assets again would be what you have at the beginning of the period plus what you have at the end of the period divided by 2. So anyway, and that in this instance would be your revenue would be 200,000 divided by your total average assets. We're just going to use the assets, which would be 472,100, would equal 0.42 or 42%. So actually, it really depends on the industry and what your assets are, whether that's good, because you could have some industries where that's really bad or ones that's good. So it really depends. And it really depends on the durability of those assets too. Solvency ratios. Solvency ratios are used to measure how well a company's cash flow can cover its long-term debt. They assess the financial health of the company and can determine the chance of the company defaulting on its debt. And let's see, there is actually 3 of those too. So anyway, solvency ratios, the first one is debt to equity ratio. And this shows the proportion of debt to equity in a company's capital structure, indicates a level of financial leverage and ability to meet long-term obligations. So anyway, debt to equity ratio equals total debt divided by shareholders' equity. So anyway, your total debt would be 247,000, and your shareholders' equity, if you're going to have to probably, I think I added it up for you, but you might have to do the math there, would be the 225,100 would equal 0.001, 0.10%. This would not be very good. You know, the higher equity, the better. So this wasn't that much equity per what you had in debt. Now let's say the equity, let's just for comparison, let's look at if the shareholders' equity was 500,000. That would bump that number up to a 0.49 or 49%, which would really be a lot more respectable, I think. So anyway, the second solvency ratio is the debt ratio. And this shows the percentage of a company's assets financed by debt, can show companies' overall debt burden and risk. So your debt ratio, and I have seen this one used, the debt ratio is the total debt divided by total assets. And like I said, it really, it shows companies' overall debt burden and risk. So number 3 of the solvency ratios, number 3 would be interest coverage ratio. And what it is the company's ability to meet interest expenses with operating income. Indicates the ability to service its debt. The income coverage ratio would be equal to earnings before interest and taxes divided by interest expense. And in our example, we would have earnings before interest and taxes. You have to take out one thing I think on there, but anyway, it'd be 43,700, and then we're going to divide that by interest expense, which in this example is 600, and we're going to come out with 72.83 times. So anyway, if this is a quarterly thing, your interest coverage ratio, your coverage ratio of 72 times anything would be fabulous. I mean, really, you're going to be able to pay that interest, and that's what they're looking at, to make sure you can pay the interest over the year or in the future. So the actual next one would be market value ratios, and these are financial metrics that measure and analyze stock prices and compare market prices with those of competitors. They track the financial performance of public companies. So these aren't going to come up with our small business lending, but we're going to give them anyway because they are very important ratios if you're looking at, investing some money, or if you're looking at public companies and you want to evaluate them. One of the main ones is earnings per share, EPS. It is really used to assess the company's profitability on a per share basis. Shows the profit allocated to each share of stock. So your earnings per share would be your net income divided by number of outstanding shares. And it is an important ratio that companies look at, or that investors look at for companies. Number two would be price to earnings ratio, and this one's used a lot. And a lot of people say it's really not that good of a ratio, but it is used a lot. Price to earnings ratio is used to evaluate the value of a company's stock. Compares the stock price to the earnings per share. So the price to earnings ratio, PE ratio, equals market price per share divided by earnings per share. And it really comes out with a number of, I guess kind of, a lot of people look at it as how long will it take, the company to really make its to make its money back, by earnings per share, to make that price, what you're paying for that stock. Number three would be dividend yield, and it's the dividend income generated by its market price. It's useful for investors seeking dividend income. It's basically dividend yield equals dividend per share divided by market price. And really, kind of the higher that it is means that the company has a better dividend percentage than other companies might have, and you can use this. So anyway, comparing ratios with industry benchmarks or historical trends, that's what provides insight into the company's strengths and weaknesses, and that's what bankers will look at or financial people will look at. Our ratios should be compared to companies. If you're comparing companies, they should be compared to companies of like size and industry. Ratios should be used with other financial information to get a real bird's eye view of the company as a whole. And like I said, most of them are used, really to analyze a company, just that one company over several years to see how their numbers are working out. Please subscribe to this channel and hit the bell icon if you want to notice the future videos. Please also like the video if you learned anything from the video. My name is Roger Schleter. This was kind of a long video, so I'm sorry about that, but I tried to cover everything. My name is Roger Schleter, and I will see you in the next video. This is part two of the two parts, where the first part was the looking at financial statements, P&L and balance sheet, and then the second part is this, looking at the ratios. Thank you very much.